Okay. So what we're going to do now is, yesterday what was the last point we did? We talked about how you take views on EuroDollar futures. Remember? Okay, so the EuroDollar futures component is not going to be part of your software-based trading project. Okay, which is one part of the case, which is the last part of the case. So the case can be discussed independent of the trading project. You can have the case as a discussion case as well, but then we have made it a little bit, hopefully a little bit better, by adding the trading project in a way that is connected to the case. So what we were discussing yesterday is the hedging because the EuroDollar futures part, we'll cover it quickly first. How you hedge floating rate. What we're going to cover is how you hedge floating interest rate risk with EuroDollar futures. Maybe we can try and open up a chart as well here if we can. Right. So what did you remember what we did? So every euro. So what we're going to do. This chart is not very good. Is because it's the time frame is. I don't want this volume. This is not working out very well, this chart. Okay, so let's close this. We'll just look at the deposit rate chart on this, on the Fred charts. We already have interest rates here. Okay, so what we discussed yesterday is, we're going to discuss the example of I'm only going to take a 1-year loan, although the loan in the case is a 5-year loan. So you're going to be looking at, if it's a 5-year loan against 3-month LIBOR, there are going to be how many interest periods? There'll be
3 months.
No, how many interest periods? No, there'll be like 20. There'll be 20 interest accrual periods. Okay, we should treat them as 20 interest accrual periods, because the interest rate on each of those periods could be different. It's not a fixed rate loan where you have a same rate of interest. It's a floating rate loan. So you have 20. You should consider it as 20 different interest accrual periods, 4 for each year, and it's a 5-year loan. Yes, this is clear, everyone. But we are going to discuss the hedging example just with a 1-year loan, because we don't want to be because the logic is the same. We are not going to discuss everything. We're not going to repeat it. Okay, we'll just show you the logic. The logic is going to be the same. So what you're going to do is, you're going to call up a chart of LIBOR, and you'll get even longer term data. I can't find the series right now, because you should be able to get this data even from the 70s and things on this platform itself. Okay, so we just take this. Alright, so we look at this LIBOR chart. So now we are moving away from the underlying positions. We have already discussed the underlying positions. We know what the underlying positions are. Now we're just focusing on the particular KRF market, which is the 3-month US dollar LIBOR, which is the KRF associated with the floating rate dollar loan, right? So here we have the floating rate. We have the floating rate dollar loan. Okay, so the KRF associated with this, no exchange rate risk, but we do have interest rate risk because this loan is on floating rates. And the particular KRF here is the KRF market is the 3-month EuroDollar. Okay, so we are concerned. So if this goes up, we are short this, as Puneet correctly pointed out yesterday, that we are short this market. The underlying position is short. Okay, so we are concerned about things going up. So we are going to now try and we're going to see how the hedging will work. Okay, so we are going to let's go here and call out let's look at the prices, and we are just going to assume that our loan is, where is the display? Okay, I think this is too big. All right, markets, interest rates. So we are now going to, what we are doing now is we are looking for the EuroDollar futures prices. Okay, because what does the EuroDollar futures price give us? So here you have the most important interest rate, short-term interest rate contract in the world. Now you can see the SOFR. I told you about SOFR. SOFR is already, now they've already got futures on this. I was not aware of this, that they already started the futures. So SOFR is the alternative to LIBOR. So the 3-month EuroDollar futures is indexed to LIBOR. Okay, and because there have been a lot of hedging, a lot of scandals with respect to the fixing of LIBOR and the manipulation of the rate. Now we have a new interest rate benchmark, secured overnight funding rate. Okay, this works, I think, on the basis of actual transactions. So now you already have SOFR futures as well. But anyway, we are interested in this one. This has much more. You can see the difference in the volumes. So the SOFR contract has not yet caught on. So the EuroDollar futures is still the most actively traded short-term interest rate contract in the world. So what we are going to do is we are going to assume that we're going to see what we are doing. So first, understand what the EuroDollar futures price represents. Okay, if you remember when we looked at our calc sheet, we went into futures, right? So when you have a price like this 98.11 half, I think it's pretty much, it was a little so the December price is now dropped a little bit. Okay, so it was 98.11 half. So at any point of time when you look at the EuroDollar futures price, and remember that because it's a futures contract, so there isn't just one EuroDollar futures price. There are different EuroDollar futures prices for different maturities. It's the same is true of options, and the same is true of forwards. So one of the common traits of these properties of these kinds of contracts, forwards, futures, options, is that you don't just get one price. Unlike a spot price, you don't get, the spot price is only one price. Okay, like this is spot euro against EuroDollar FX. This is just one price. It's for 2 days. The settlement, if you trade at this price now, you'll be settling. The settlement date is going to be 2 business days from today. That's a spot price. But if you look at futures or forwards or options, you've already seen in the case of options, and you've already seen in the case of futures also, you can see how many different prices there are. There are going to be multiple prices for each maturity, one for each different maturity. Okay, for different contract periods, different contract months. We call them contract months. So what we're going to assume is we'll just take the simple, simple quarterly resets. So we are going to assume that our loan, the loan that we are trying to hedge, okay, the loan that we are trying to hedge has three remaining. So one setting was already done in December. Okay, so we have 3 remaining settings coming up. Are you following what I'm saying? Let's draw this once again. Okay, let's draw this once again. So we have only 3 remaining settings left. So let me just remove this here. Okay, I will keep one. I will remove this, and then we'll just further. Yeah. So we have this now. One setting we already know the rate. Okay, so we'll change the color. Are you guys able to see the colors? Yeah. Okay. So one setting. So first understand what the EuroDollar, and let's assume that let's take these prices from the website. Okay. So let's assume there are settings that the periods that I've drawn here. Where is this? Yeah. So the periods that I've drawn here. Okay. These are this we already know. We are over here. Okay. We are over here. Let's assume that we are over here, and we have one period over here for which we already know the interest rate, so there's no risk. So I've changed the color. Okay, there's no risk. Now for these we are at risk because we don't know what the fixing is going to be 3 months later, what the EuroDollar deposit rate, interest rate will be for 3-month EuroDollar deposits in London 3 months from today. We don't know what that is, because when we look at this chart, it can be pretty scary, because if you have large loans, in this case the loan is very small because of the constraints of the project, but if you have a large loan, even this kind of movement is quite big. Okay, we're moving from 28 basis points to 255 basis points is a huge move on 3-month interest rates. All right, so you can really get killed in terms of your interest liabilities, how much money you have to pay to satisfy your interest liabilities. So this what we look at this chart and we are a little bit apprehensive. So we are now looking at our forward settings. So this is 3 months from today, this is 6 months from today, and this is 9 months from today. That's our risk. Is everyone clear about this? We have simplified the example because the logic will be the same. So I don't want to draw a 5-year loan set of periods. So we're going to assume that it's a 1-year loan, and we have to cut, but we are concerned about this period, this reset, this interest rate fix. We are concerned with this fix and this fix. Everyone clear? Yes. Let's assume that these are actually represented by these contracts. We look at this, we assume that they are going to be represented by the March contract, the June contract, and the September contract. June is July, August, September, right? Yeah, so the September. So these are the quarterly cycles. So March, June, September, December. Okay, this is clear. This is what we call the quarterly cycles for the interest rate contract for all futures contracts. So are you following what I'm saying?
Yes, sir.
That we assume that this is March 2020, this period here. This is March 2020, whatever the settlement date, and seems to be around halfway through the month. So we'll say this is going to be fixed on the fixing for this particular contract is going to be just like here. You can see for the December contract, it's December 16th. Okay. 16th of December, so I just assume that it's going to be instead of going through the contract specifications and seeing exactly where the third Thursday is, okay, or third Wednesday is, then go back 2 business days. Instead of that's what you would do in real life. Okay, in real life, what you have to do is go into the contract specs. Okay, look at the what is the settlement rule. Okay, let's go through that exercise once so that you know what has to be done in real life. In real life. Let me put down these prices from here. Okay, we'll come back here. Okay, contract specs. Let's come in real life. What you have to do is your actual in real life what you'll see, what is the settlement. Yeah, it is financially settled. Okay, so you can't actually deliver. There's a part where it is they've told you where this is minimum fluctuation. Yeah, so termination of trading is third Wednesday of the contract month. Okay, can you see this? Second London bank business day before third Wednesday of the contract month. So in real life, what you'll have to do, suppose you have a 5-year loan, you'll have to do this for every interest fixing date that you're looking at, which is a source of risk. Is everyone following what is being done? If you don't follow at any point, you have to ask questions. Okay, so is everyone following this system? Okay, so you have to go for each of these periods, okay, and identify the relevant contract, and then for that contract you have to go so for the March contract I would have to go to find out what is the date for the third Wednesday of March 2020, and then I have to go back I have to go back 2 business days from that day, 2 London bank business days from that day. So the third Wednesday is 11th, and I say 10th and 9th are open in London. Then I have to go back from 2 days from 11th to 10 and 9. So I'll be looking at 9th of December as the fixing date. Okay, is this clear? 9th of March as the fixing date. Yes, everyone is clear? So for our purposes, this equivalent of the fixing date, the equivalent of 9th of March in this example that I gave you, we will assume that it's always the middle of the month. Okay, just for the sake of, but in real life you'll have to go and identify the actual date. Yes, and we are going to assume that this 9th of March part that we mentioned, that corresponds to the actual fixing date on the loan. Remember, because the loan is also the loan is being negotiated with banks. Are you guys following? Is everyone following the discussion?
Yes, sir.
You will have to identify the actual settlement date, the fixing date that applies to each futures contract. Okay, and how do you identify the futures contracts? You look at the terms of your loan. The terms of your loan will say that your LIBOR is going to be fixed on some date. Okay, maybe on the 15th of March. So every date will be mentioned. Okay, or a rule will be given by which you can figure out every date. So when you look at your loan agreement, you will see in the loan agreement what are the dates for the LIBOR fixings that will apply to your loan. Is everyone following? Okay, so we assume that the loan agreement also, the LIBOR fixing dates that are written in the loan agreement correspond to these contracts. Okay, if we go back to our, so what is this? I should also memorize this now for the sake, so you don't have to keep coming back. So third Wednesday of the contract one, that's what I thought. Yeah, so because every contract has different. Okay, now we go back to quotes. All right, so now we'll see. We are going to assume so what we are going to assume, let's make this very clear. What we are going to assume is that all of these, when you take any of them, you take the March contract, the June contract, and the September contract, okay, and whatever the actual and for those, each of those contracts, you apply this rule: find the third Wednesday of the month and then go back 2 bank business days in London, and that's your LIBOR fixing date for that contract. Is everyone following? Okay, so, and we assume that that LIBOR fixing date corresponds exactly to the LIBOR fixing dates mentioned on our loan. Yes? So if we get, and we are going to assume that, say, that says 15th of every month for the sake of simplification. Yes? So we are going to, and we are going to assume that it's, so therefore these are going to be perfect hedges. These instruments, these EuroDollar futures contracts will be perfect hedges. Yes? So now understand what the price, what the futures contract price means in the case of EuroDollar futures. What is the meaning of this price? Let's write down these prices: 98.28. These prices are 98. Okay, it's here. Okay, so let's write down these prices. So right now it's 98.28. 98.28. All right, and what is this? 98.28. Remember the next 2 prices. Next is 98.36. Is it 36? 98.36. You guys can see at the back, last bench, 98.36, and then September is 98.41 half. Okay, so let's write this: 98.36, 98.36, and 98.41 half. All right. Now what does it mean? If we see these prices, what is the meaning of these prices? So first understand, can anyone tell me what is the interpretation of this price? What does this tell you about the market's forecast for the cash market rate? What is the market's forecast for the EuroDollar fixing for these contracts? The last EuroDollar fixing for these contracts. Yes, Bharat? Since you're smiling, you can tell us. Yes. Question. What is the market's? You can see the market prices. You can see the market prices.
Yes.
98.28 for March.
Yes.
98.36 for June, and 98.41 half for September. Yes. Just take one of them. Just take one of them. If the market price, if the March 2020, okay, and assume that the settlement date, the relevant futures fixing date for the settlement of this contract, okay, the final settlement of this contract, assume is 15th of March. Okay, which means if there are no holidays and there are no, that means 17th March would be the 17th March would be the third Wednesday of March, and we assume that that 15th and 16th are open in London, so we go back 2 business days, so that's 15th of so this contract will settle finally against the 15th March 3-month EuroDollar deposit fixing in London. Okay, everyone follows?
Yes.
Okay, so now I'm asking Bharat, what is the meaning of this price? Now, if the market price now for March 2020 contract, for the March 2020 contract for EuroDollar futures is 98.28. So what does that tell you about the market's forecast for the 3-month EuroDollar deposit fixing that will occur on 15th of March? Is my question clear? Is there any information? My question is there any information in this price? You have to all understand what this means. You have to understand what the EuroDollar futures price means. We have already gone through the exercise. I don't know why people are not able to answer. We have gone through the exercise twice. What information does this price give you about the market's forecast for the 3-month EuroDollar deposit fixing that will occur on 15th of March? Is my question clear?
Sir, are you asking that what is 99.28?
No, 98. I don't know if you can see. Can you see 98.28? Yeah. So the current EuroDollar futures price, for March 2020 is 98.28. My question is, what information does that contain? Is the what can you say about the market's forecast? Yeah, let's see. Let's see what Tarun has to say. Let's see what Tarun. Okay. No, I've completed my question.
What is the current market?
What exercise did we do here? 1 minute. What exercise did we do here? Okay, let's take.
We subtracted 100 from it.
Yeah. All right. So this will be this minus 100 minus 2.5. Okay. So now let's see. Now are you able to follow what this is? Okay. So what is, remember, if you go back to the EuroDollar contract specs, the price is defined as 100 minus the fixing.
Yes, sir.
Right? So that means when the EuroDollar futures price is 98.28, the current market price, the forecast embedded in this market price, this price is actually making a forecast for what the EuroDollar 3-month EuroDollar deposit fixing will be in London. This is the market's forecast. The market's forecast may be wrong or it may be right, we don't know, but it's a market price that has tremendous value. Okay, market price has tremendous value rather than all these airy-fairy things like, you know, what you have in the equity risk premium. Nobody knows, you don't know where to find it, you don't even know where to find it, but at least the market price and you know where to find it. If you go to the CME website, you can see where the market price is. So the market price has tremendous sanctity. So what does this mean? That means the market is predicting based on this price that the futures, the 3-month EuroDollar fixing in London on 15th of March is going to be 100 minus this price. Now the price has changed. The night price has changed. Okay. Okay. So the price is going to be 1.72. Yes. Are you following this?
Yes, sir.
Understand first what is the meaning of the EuroDollar futures price. So this is what it means across the curve. Okay, this is the entire EuroDollar futures curve. Okay, this is what it means across the curve. That means for June, what is this now? Again, I have to cut for Bharat.
Sir, what happened?
What? You are talking to her?
Sir, no, sir.
What? No, sir.
Groupism.
That means
I just ignored you.
no. She didn't say anything. I'm not penalizing her, but you talk to her.
So I'm not talking to her, sir.
No.
Now
Then you are just turning. No, 1 minute. If you communicate with her, that is also. If you turn towards her, that is also a penalty. Okay. All right. 1 minute. Let's go back to work. Okay. Let's. No, he's okay because he is called Aurora. So Bharat means Sharma. So okay. All right, guys. Now let's go back to. Let's go back to the discussion. Okay, so now do you understand?
Yes, sir.
When you see a EuroDollar futures curve like this, what you can find on the CME website, now you can understand the meaning. So you can immediately put into a spreadsheet. You can put in a dynamic data exchange and all that Excel. You can put it into a spreadsheet, take the prices into a spreadsheet. All right. So and then you can lay out what is the market's forecast. You can see a string of forecasts. Right. Already here you can see a string of forecasts. That forecast for 15th March fixing is 1.72. Forecast for 15th June is this. The forecast for 15th September is this. Is this clear now? There is information in the market price. Remember, market price has tremendous sanctity because all this people talk all kinds of things. Oh, this is overvalued, undervalued, whatever. Okay, but the point is the market price is what it is. Okay, so therefore that has tremendous sanctity. So now you can see the market's forecast. Now what are you going to do? You are worried about, so the market seems to be predicting that the EuroDollar LIBOR, that 3-month EuroDollar deposits will actually start falling. Okay, that's what the market is predicting, right? So March, June and September. But suppose you don't agree with this view. Okay, suppose you're the treasury manager. Now Puneet takes a view on this. He looks at the chart and he decides that no, the market's view is not correct. I actually think this is going to shoot up. Okay, so he has a different set of forecasts. And also now you understand this is forecast based valuation. We are going to use the same market price versus fair value, which we have done a couple of times already. Okay, because you guys are not paying attention, so you are not able to answer this question. Okay, this was already discussed. So please make sure you understand it properly. Now we're going to use the same price versus fair value comparison Okay, and where is the fair value going to come from? It's going to come from a forecast based valuation model. All right, so this is going to be what is going to happen here. Now you're the risk manager. Okay, you are concerned about the fact that the market's forecasts are wrong, that actually because market forecasts could be right or they could be wrong. All right, so and your view, so here's where the view taking comes in. Now you understand why I make you focus on financial markets, because in everything you do in corporate treasury or on the trading desk, everywhere in finance and a finance related role, capital raising, everywhere you will have to take views on markets. Okay, you'll have to take views on markets. So that's what you do now. You sit here as a risk manager, and you take a view on markets. And here what he's doing is he's taking a view on the EuroDollar deposits, what the fixing rate will be, and he takes a very bullish view. So let's assume, so what he does is he puts in his own forecasts. Okay, so his forecasts are, let's say this is going to be 1.98, this fixing is going to be 2.3, and this fixing is going to be 2.45, let's say. This is clear? These are your views. Okay, so let's write this down. These are views. Okay, these are actually what we would call implied forecast. All right, and this is the EDLR prices. Okay, so the implied forecast is implied by the futures price. Why implied forecast? Because the futures price is implying a forecast for the thing. So now, based on your view, so this is the forecast that you have. This is a separate forecast that the treasury manager has come up with. His independent analysis of the market tells him that these are going to be the fixings. So based on the forecast, he's going to come up with a forecast based valuation. So based on this should be so we are going to come out with let's write this down so you understand clearly how everything works. Is this, make sure it's correct. It's 100 minus this. Okay, so now what you have is, let's copy this. Oh, sorry, we don't need this. All right, so this is what you have. Now what are these? This is, we don't need to describe this. This is this is the fair value. This is the fair value of the EuroDollar futures, the respective EuroDollar futures contracts, okay, which we are interested in, okay, based on my forecast based valuation. The treasury manager makes a forecast for 3-month EuroDollar deposit rate fixings that are going to happen in the future for the periods that relate to his loan, right? These periods that we have not yet fixed the rates, okay, because we don't know 3 months forward, 6 months forward, 9 months forward. We don't know what the fixings are going to be. The market's forecast is this, and this. Sorry, the market's forecast is this, and this. But the treasury manager doesn't agree with the market's forecast. He should not accept the market forecast. He should always come up with his own independent view. And he comes up with his independent view. His views are this, and this. Based on his views, he comes up with, remember, forecast-based valuation. This is no different from NPV or your Gordon growth model or IRR or any of your other stock valuation models, earnings discount model, bond valuation, anything. Okay, so same kind of format, forecast-based valuation. The fair value based on your views, the fair value is, remember, this is actually this minus this, right? So this is the fair value of the futures contract, which is based on your forecast. Okay, so this is forecast-based valuation. Now what you do is you compare the fair value to the market. So the fair value of the futures contract is here. You're going to compare it to the market price. Okay, and what do you find? That here the market price is higher than fair value, higher than fair value, and higher than fair value. Yeah. So overvalued is what the people in the market will normally use. So you need to learn at 2 levels. So in the market, people will say that futures contract is overvalued, but actually the technically correct term would be it is overpriced. It is overpriced relative to, because the market is never valued. The market price is always a price. So understand it at 2 levels, because if you start going and talking like this in the industry, people will also not be able to understand you. So you will talk to them about being overvalued. That's what people will say. But you have to understand that what they're saying is actually technically incorrect. What they should be saying is that the market is overpriced relative to my assessment of fair value. My assessment. Now your assessment could be different. Rajan's assessment could be different. Okay, because because it's a forecast based valuation. It's not AFV. It is not proper AFV like FX forwards, FX cross rates. It's not that kind of, or like put call parity. Okay, those are real arbitrage free valuation examples. So anything other than pure arbitrage, true arbitrage free valuation is always going to be a subjective valuation. All right. So therefore, the correct statement that you should be making is the market is over. In this situation, you would look at this market and you would say the market is overpriced relative to my estimate of fair value. This is clear. But in the industry, what people will say is the market is overvalued. Okay. So you have to understand it in both ways. You have to talk their language, but you should also, every time you say that, you should also understand that the language is technically incorrect. Because why is it important to be technically correct? Because it makes your thinking clear. Okay, so that's very important. Okay, so now you understand. Now the decision is very clear. What is he going to do to the EuroDollar futures contracts? He's going to be selling. Is everyone clear about that? Yes? Mehak? Clear? Because you're going to be selling because market price is higher than fair value. And the framework that you're using, in that framework, the system is that if market price is higher than fair value, you sell. If it's below, you buy. Okay? In situations where it's possible to sell, like some Indian equities, you discovered that even when you wanted to sell, you can't sell because the stock lending and borrowing system is not well developed. But in theory, you would sell. Yes? Everyone's clear? Okay? Aroda, are you following? Yeah? 100% clear? Okay, so you're going to be selling. Okay, so that's what you do. So in this case, we are not going to be including this because we don't have enough capital in the account. We are not going to be using this. We would not be trading the EuroDollar futures in our project. But you should understand clearly how it would work if you did not have a capital constraint. In practice, when you're managing the hedge book for a corporation, you would have enough capital, I would assume. Okay. To support your hedging activities. The reason we are not doing the EuroDollar futures as part of your project, we don't have enough capital, okay, in the trading account. Is everyone clear what you would do? You would form a view and then you would sell. If it is otherwise, you would buy. Now let's look at it the other side also. Let's assume now, let's change it around. What would you do? So if you have, let's say, now let's change your implied forecast and your view. Let's make your view 1.5. Okay. In this case, your view is, let's make it like 1.42 or 43, and let's make this 1.33. Okay. Okay. In this case, what is going to happen if these are your views? What is happening now? Market price minus for fair value. If we write out one sec, market price minus fair value, we write this expression. Okay. All right. Now what do? We buy. Okay. Now here's the problem. Now we are going to go back into the decision problems. Okay, here you are not going to buy, because here what you are going to do is you will just sit on the sidelines. Okay, because you have a passive risk book, you already have an exposure. Okay, so yeah, so if you are short, in this case your underlying position is short. Okay, so this is where you see the asymmetry in the, now you see how the decision problems are slightly differently solved in the two situations where you have a speculator's book and a hedger's book. There are some slight differences. Okay, the decision problems in theory are all the same, but the way you solve it, some of them are automatically solved and all that. So in this case what you're going to do, because remember your underlying position, now we'll actually we should have it's difficult to sequence the topics in the right way, but the point is that you are already, why are you looking at the EuroDollar futures prices at all? Because you already have an underlying position. Okay, this is clear. You are short. If you are short and your view is that the market is going to keep on coming down, okay, in this case you don't take profit. Okay, because you need to let this, we can look at a more advanced situation of a dynamic hedging program, but we're not going to get into that. We need to first understand how a hedging program would work. We are going to consider a simple hedging program, okay, where so in this case what is going to happen, because your underlying position is already short, so it is like here, you're already short this market, the market is here, You're already short, okay, and your view is the market is going to keep on falling. In this case, therefore, you will not buy. This is clear, even though the market price is below fair value. Okay, the framework the application of that framework has to be modified by the fact that you already have an underlying position, because this is a hedger's book. Okay, it's not a speculator's book. You did not start with zero risk. If you were running a speculator's book, then you would buy. If you were running a speculator's book here, because that means you have zero position. You have zero position to start with. Okay, in a speculator's book, you would buy. So you would follow both sides. If market price is below fair value, you would buy. If it's above fair value, you would sell. But in the case of a hedger's book, because there's already an underlying position, that means what you're looking at is a situation where you are already short, and the market, you're expecting the market to fall further. Okay, why was he buying in the other case? Why was he buying? Because he was short and he was afraid that the price would go up. Is it right? We are calling this the price, the interest rate. So he was afraid that the market would go up. Okay, so if you are already short and the market is going to go up, then you're going to have losses. Yes?
Yes, sir.
So what you are trying to do here, you get a flavor of how hedging works. How hedging works and how the hedge position works relative to the underlying position. Remember, you always have an underlying position in this situation in a hedger's book. Okay, you already have the underlying position where you're short. So why did he buy in the earlier case? Because he has a very bullish view on the market and he's short, and he's afraid if the view comes out to be proves to be correct and the market actually shoots up, then he'll lose a lot of money on the underlying position. Are you following the logic? Yes? Okay, that's why to hedge that he bought, okay, to offset that. Are you following the logic? He was buying because the underlying position would incur losses. He would be paying more on the loan, but the futures contracts would show a profit if he bought it in the earlier case, and then it went up, and futures contracts actually in the earlier case we're talking about selling the futures contracts. Okay, he would have sold the futures contracts, and then if his view was correct, as the rate started rising, the futures contracts would drop in value and you would make a profit. Are you following? In the previous case, you would have sold the futures contracts. Okay, we should have done this we can do this in two cases. We can go and talk about that way we can see both together without wiping anything out. Okay, so in this case we can have different views, say 1.95, 1.98, 2.35, 2.34 and 2.65. all right, now you see all the way there is a difference between the market price is above fair value for the futures contracts. Are you following? This is the earlier case that we looked at. In this case, now he's going to be a seller of the futures contracts. And how will the hedge position work? Now you get through this example, you get an understanding of how the hedge position works. Remember, hedge position is like a offset. Okay, think of it as an offset. Let's do it this way, as an offset. You understand what offset is? Something.
Opposite to our registration.
Yeah, I mean something which is kind of cancels out something else. Okay, so in the first round maybe you have a score of plus 10, but in the second round you have a score of minus 10. So your net score is 0 because your second round score has perfectly offset your first round score. Okay, so that's what offset means. So the hedge position works like an offset. Okay, so let's just talk about this kind of let's look at it this way. Okay, so if you have an underlying position here which is going to show losses, you will set up a hedge position here which is supposed to show profits. Okay, so understand why. So let's go back to this example, the first case where he would be selling futures contracts, to use this example to understand how the framework of hedging works. Okay, so the idea behind hedging is that you can't disturb the underlying positions. Okay, these underlying positions that you have, remember, these cannot be disturbed, because if you look at these positions, the inventories, they will be sold whenever the selling team can find the customers. So that is something that relates to the physical operation of the business. Okay, they have a normal cycle of selling. There may be a seasonal pattern and this and that. Okay, maybe gold, India and all would be buying gold before the the festive season. Okay, so there's more demand at that time. So the seasonalities. So the underlying operation of the business cannot be disturbed just because you want to hedge. Okay, now we are going to see how a hedging program works. The hedging program works by basically setting up hedge positions, where the hedge positions, the profit P&L on the hedge position will offset the P&L on the underlying positions. Are you following? Yes. So this is the principle that we'll understand it better, and everything is there in your notes, so you don't need to write anything as such. So all the things are explained in the what is a hedge position, everything is explained in your notes. But first let me explain the concept, a brief explanation of the concept with this EuroDollar futures example. So the way it works is that you set up a bunch of hedge positions. You already understand underlying positions. We have already gone through underlying positions. Okay, on a passive risk book you will see a bunch of underlying positions. So you will be conscious of your underlying positions, and then you will basically be monitoring the market. So for instance, what did you do here? The idea is you monitor the market, okay, each of the KRF markets for the underlying positions, and then if you feel that the market is going to move in such a way that the underlying position is going to make a loss, okay, like you did in this case. Here you were monitoring, you knew that your underlying position is short. This is the KRF market that you're looking at, 3-month EuroDollar interest rates, okay, and you know your underlying position is short, and after analyzing the market and taking a view, you came to the conclusion that this market is going to rise rapidly. And if your view is correct, and you assume that your view is correct, and that's how you hedge, okay. Your hedge decisions are based on the assumption that your view is correct, okay. So therefore you took this view, and then you had this view that is very, very bullish, it's going to go up sharply. And then what would the impact be if actually interest rates go up sharply? Your underlying position would show a loss.
Yes.
Yes, because your interest liabilities would go up sharply.
Yes.
All right, so therefore now you're concerned. And you have the other constraint that although you are very concerned that your underlying position is going to get into a loss, you can't go back to the bankers and say, please renegotiate my floating rate interest rate loan, rewrite the agreement and make it into a fixed rate loan. That's not how it works. Okay, you can't go and do that. So for all practical purposes, you can't touch the underlying position. From the perspective of the hedging team, you have to assume that you can't touch the underlying positions. Okay, so they will remain as they are, and they will run off based on the normal operation of the business. When there's seasonal demand for gold, then they'll sell off some gold, and then the underlying position will reduce. Remember, this balance sheet has to be conceptually almost instantaneously reconfigured and rewritten based on new information. So if some of the inventory runs off, okay, you have to update your inventory figures. Are you following? Okay, so this is meant to be, it's not like something static and you sit on it for 5 years. It doesn't work like that. You have to continuously update the underlying positions on the balance sheet based on information that you get from the business. The business will inform the hedging team that we have sold 2,000 ounces of gold. Then you have to reduce your gold inventory by, and they will also update you on fresh additions to inventory. Okay, so net change in inventory will be informed by the business, and that the hedging team will have to update. So which means your balance sheet has to be updated at all times. Okay, so that is assumed here. You have to assume that every second to second you are updating the balance sheet with fresh information. Okay, all right. So the point is you can't touch. Yeah.
So when we are on the passive risk book and when market price is less than fair value, so up to what time we will wait?
No, don't make these into general statements, because what we did, well, I'll tell you one minute. Let me first clarify one thing. When you this situation which we showed you a situation where the market price is less than fair value, and we decided not to do anything. Okay, so don't make this into a general rule, because this is also this action or lack of action, this decision not to do anything, that is also based on the fact that your underlying position in this market is short. Your underlying position in this market is short. If it was long, it would be a different decision. So don't generalize this. At this point, don't generalize. Are you following? Because I think from your question, it seems like you are trying to evolve a general rule. Okay, don't evolve this as a general rule, because this particular decision not to do anything is based on the fact that your underlying position in the EuroDollar future, in the 3-month EuroDollar interest rate market, the KRF market, is short. If it was long, it would be a different decision. So don't generalize from this to all things. Just wait for a while, you will get the picture. So first you understand that a hedging position the hedge position, the way that hedging will work is that you will have to set up a bunch of offsetting hedge positions. Okay, you cannot touch the underlying position. Everyone knows underlying positions now, and you can also see that if you have, for instance, here in this market, your underlying position is short, and if the market shoots up rapidly, then you are going to have a lot of losses. That you understand? So now you have certain constraints. You have a set of underlying positions. They are connected to certain KRF markets. You analyze those KRF markets and you take a view. Okay, in this case, when you take a view on one side, in this case your underlying position is short and your view is that the market is going to shoot up. So straight away you can see that your underlying position is going to generate huge losses. Alright, so you need to do something to mitigate these losses. But at the same time, you are not allowed to touch the underlying positions. You can't go back to the bank and say, please change my floating rate loan into a fixed rate loan. So therefore you need to set up some hedge position. Okay, you need to set up a hedge position which is going to be, remember the word offset is the only word you need to remember. You need to set up a hedge position which will offset the, assuming that your view is correct, assuming that the market actually shoots up like you expect. Okay, in that case the hedge position PNL is going to offset the underlying position PNL. Your projection for the underlying position PNL is going to be negative. Yes? Nobody is nodding. Based on your market view that the market is going to shoot up, then the projection for the underlying position PNL is that it's going to make losses. Yes? So yeah. So have you followed up to what point have you not followed? I mean, at what point have you followed?
So just the last part that you said.
Yeah, so underlying position you understand, and every underlying position basically connects you to a KRF market. Okay, is an underlying position in a particular KRF market. Okay, so in this case you are short the EuroDollar 3-month EuroDollar interest rates. Okay, it's like you're short 3-month EuroDollar interest rates. So what do? You are conscious of your underlying position, you monitor the particular KRF market, and you form a view. Okay, all these steps will be written down for you, so don't worry about that. You'll have to all that, but try to understand the concept here. Okay, you are following this. You form a view. Now, based on your view, you are projecting that the underlying position will have huge losses. Okay, so now at the same time you're not allowed to touch the underlying position. So your goal is now the word offset. You are going to set up a hedge position in such a way that when the underlying position is losing money, the hedge position should make money. Are you following? Yes. This is the basic idea. That's why you should remember only one word, offset. The hedge position must offset the PNL of the underlying position. And the PNL forecast you're coming at based on your forecast. That's why everything is based on your market view. That's why I'm forcing you to look at market prices, real market prices, because in every decision making role in finance, you'll have to take views on markets. Okay, so you can see in hedging also, you take a view on the market. So you see that based on your view, the underlying position is going to make losses. So you need to set up, so what kind of hedge position will you set up? You will set up a hedge position which is going to make money when the interest rates start shooting up. Right? Is this clear? So therefore you can see clearly, and there's another way of doing it basically that you've already seen this, that essentially what you do is you have a forecast. We are looking at this one actually. Okay, bullish on 3-month dollar rates. We just write rates. Okay, this is bullish on 3-month dollar rates, and that is bearish. Okay. All right. So this is bearish on 3-month dollar rates view, and this is bullish. So bullish and bearish, we normally use it as a forward-looking description of a forward-looking view. Okay. So this is in this situation. So what you do is, so basically you can apply this framework as well. If you apply this framework, you mechanically get there. All right. And so the basic idea here is, another way of understanding the hedge framework is that you are now going to set up a hedge position whenever your forecast suggests that the underlying position is going to lose money. Okay, only when it's going to lose money according to your forecast. If the underlying position is projected to make money, then you don't do anything. Are you following? We'll come to that. But first let's understand the losing money position. Yes, everyone's following? Okay, So your base, because your view is projecting that the underlying position is going to lose money, you are now very concerned. At the same time, you can't touch the underlying position. So you are going to now set up an offsetting hedge position in such a way that that hedge position should make money when interest rates start shooting up. Because when interest rates start shooting up, your underlying position is going to lose money. So the basic principle, so here Parul is an example of a basic principle that you can understand, a general principle which applies in all situations, that your hedge position should be set up in such a way that your hedge position P&L will offset the underlying position P&L. And these are both projected P&Ls, projected based on your market view. So your market view always comes into the picture. Yes, because the hedger's market view has to come into the picture. Yes, everyone follows now. So what kind of position makes money in Eurodollar futures? What kind of position makes money when interest rates, when the cash market interest rates start shooting up? It is going to be a short position, because as the market realizes that rates are rising, the Eurodollar futures prices will start to fall. Can you see? Because they are associated with essentially it depends on how long the market takes to wake up sometimes, but eventually the market has to wake up, because this is coming, let's say this is for March, this is for June, this is for September. So as rates start shooting up and the market is predicting 1.72, so let's say if you come to January, then the rates are 1.92, then you come to February, the rates are still 1.93, then in early March the rates are 1.95, then it's impossible for the market to retain this price, because this price is consistent with 1.72 cash market interest rates. Are you following? Okay, so by this time the market would definitely have come down. So the broad rule that you can derive, now this is particularly relating to Eurodollar futures, so this is a very important contract, so it's important to understand, and you can use it for hedging in short-term interest rate risk, okay, going out several years, because the contract is very liquid. Okay, you can very specifically hedge depending on how your loan dates are set up. Okay, you can very specifically hedge the floating interest rate risk. So therefore the rule on Eurodollar futures is that if cash market interest rates start going up, then Eurodollar futures prices will start falling. This is clear? Are you following this? It follows from this system, the way it's computed. Sooner or later the futures market has to come in line with the, remember we did convergence of cash and futures markets prices, we did that, remember, in the earlier part of this course. Look at it, look it up in your textbook. Okay, eventually the futures and cash market prices have to come together. Okay, so are you following this? So the general rule for Eurodollar futures we can remember is, if cash market interest rates start rising, Eurodollar futures start to fall. Okay, so therefore what you're going to do is, now that your view is that the cash market interest rates are going to go up, okay, cash market interest rates are going to go up, therefore consistent with this, futures market, your view for the futures market is that futures prices are going to fall, Eurodollar futures prices are going to fall. Okay, and you can basically formalize this in this framework, so that way you're able to connect it to the theoretical frameworks that you have covered, just like your NPV, IRR, Gordon growth model, same framework. You have a forecast, based on that forecast you have a forecast based fair valuation, and you see that the market price is higher than the fair value based on your forecast. So therefore market price higher than fair value, so you sell. Okay, that's another way of justifying it. But the other way of thinking about it intuitively is that you see that the underlying position is likely to start making huge losses, so you are trying to set up a hedge position which will make huge profits when the underlying position is making huge losses. That is when interest rates are shooting up. Is everyone clear? Okay, so in this case what you are going to do as treasury manager is you are going to start selling futures contracts. Okay, so you will go into the market and you will sell all these different maturities. These are the rates that you're looking at. You will be selling out all of these. Okay, because in all cases market price is higher than fair value, and if you sell this, what will happen as market prices start to rise? As market prices start to rise, your underlying position starts losing money, but your hedge position, now these short Eurodollar futures contracts, the short positions that you have created by selling these Eurodollar futures contracts, those are all your hedge positions. This is clear. Those are going to be called the hedge position. We'll get to the, take you to the text right now where the hedge positions are defined. But I just wanted to explain it first so that has everyone understood the concept? Okay. So the hedge positions, they will start making money because as cash market rates rise, in general, we know that your Eurodollar futures prices will fall. So you have already gone short now. Just think about the hedge position now. In the Eurodollar futures market, you have gone short and then prices start to fall. Then you make money. Yes, if you go short in any market and then after that prices start to fall, then you make money. Yes, Yash, your WhatsApp also agrees with that assessment.
Always, sir, always.
Okay, alright, so is this clear? The logic is clear? You set up, so the general principle that you need to remember is that you cannot, certain general principles. Okay, now let's get to that. Let's get to some of the theoretical material which is there in your notes. I think this is the one. Yeah, maybe we need to make this 115. Okay, can you guys still read on the last bench? Hardik, you can read this?
Yes, sir.
Okay, alright, now let's look at some of the material in your text. So even this is too big. Maybe we have, what is all this talking here? Who is talking?
Minus, sir.
Minus. Yes, yeah, SG1 minus.
Sir,
SG1.
Sir, yeah.
You haven't said anything, okay. I don't want to hear any noises, okay. There should be no noise. There should be pin drop silence. You just concentrate, come in and concentrate for 1.5 hours so we can maximize our learning, okay.
Yes.
No noise, no talking here and there, okay. Alright, so let's go to your notes where everything is written down. Alright, let's look at this underlying positions and hedge positions. So whatever I've told you, I have already explained here. KRFs already explained. Underlying positions already have been explained. Okay. Now let's understand hedge positions. Okay. I just wanted to give you the scheme first. The scheme is also mentioned in your project brief. If you read your project brief, you'll see that all these steps are all written down. What you have to do? You have sized up your passive risk book. Size up your passive risk book. Anytime you go in as a risk manager, whether a passive risk book or an active risk book, size up the book. Look at identify the KRFs. Okay. Identify the underlying position in each of the KRF markets. All these steps are written in your notes, in your project brief, okay? But this is what you have to do. Very basic stuff. If you revise it 1 or 2 times, you'll remember it. So whether it's a speculative book or a hedge book or a passive risk book, it's the same process. Size up the book, identify what's there on assets and liabilities, okay? And identify KRFs. Then list down the underlying position for each KRF market, which we did here. Okay, then take each of the KRF markets like you did in the case of the Eurodollar futures. Take each of the KRF markets and go through this exercise of forming a view. Form a view on the market using either fundamentals or technicals. Okay, form a view on the market. And once you form a view on the market, then you know which side your risk is on. Because in this particular market, your underlying position is short, so your risk is on the upside. If this market shoots up, then you're in trouble. So you take a view. If it's going to go up according to you, then you need to quickly put on some hedge positions to cover the risk. But if it's going to go down according to you, then you're not concerned because your underlying position is short and the market is going to go down. So according to you, you're not expected to lose money on the underlying position. Are you following? Okay, same exercise has to be gone through for each KRF market that you have on your book. Yes? The process is the same, you just have to repeat it. So there's no new learning there. Yes, everybody follows? Okay, all these steps are written down, but try to understand here what is being, what the scheme is. The scheme will make sense. It's a logical scheme. Once you understand it, study it for a couple of times, you'll understand and then you'll never forget it. Okay, so always focus on understanding. Even if you understand in Hindi, if some of you think in Hindi, some people may think in English, okay, doesn't matter what your thinking language is, but at least understand it in your own head. And as I said, your English, when you write your exam, I'm not going to penalize you for grammar. You don't even have to write proper sentences, but you have to use the keywords so that we know that you understood the point. Okay, all right. So for every market, now every KRF market, you have to go through this exercise. Form a view based, if your underlying position is long, then we can see it here itself in your project brief. Where is the project brief? at one part, yeah, at one part of your project brief it says this, that, so as I said, some of the cell numbers may not match. All right, you'll see the whole scheme. Okay, yeah, see, if your underlying position is long, okay, this is already, now we discussed short position in the EuroDollar futures case, but now reverse it. Okay, this hedging logic, everything is written here, but you have to understand the logic for it. Okay, so in this case, if your underlying position, let's say now if we take another example, which is no, not this, here. So let's take the example of, let's say, gold. Okay, we look at gold. Gold is also one of our KRFs. Okay, our underlying position in the case of gold is long. Okay, so I draw up the gold chart here. So I have to go by each KRF market, and this I'm not going to repeat because the process is the same. The logic is the same. You have to go, if there are like 15 KRFs on the risk book that you're looking at, if there are 15 KRFs, then maybe there are 25 KRFs, then you have to do the same thing 25 times. But it's actually the same thing, so there's no new learning as such. You just have to repeat the process. Are you following? Yes? So on a large risk book, you can have many
KRFs.
Yes? Okay, so you look at gold, alright? You form a view on gold. In this case, let's say the view is that gold is going to fall. Okay, we have got a very short-term horizon, but we want to make it a little bigger. Okay, let's make this a little bigger. Alright, so you can look at this and you form a view that, let's say the view is that the chart is bearish now. This is going to fall quite substantially, going to come back to 1300. Let's say that's the view. You analyze the market, you have to form a view. Let's say in this case your view is bearish. Now your underlying position is, in gold is, yes, everybody is not clear. Srishti, what does your WhatsApp say? What is the underlying position? In the case of Magma, what is the underlying position in gold? No, long. Everybody is saying long now. She'll say long. Yes. No idea. Okay, good. Anyway, so the underlying position is long. I was worried she might say Elaichi or something. So everyone is saying long. She might say Elaichi. So, okay. No, anyway, okay. Now understand this. 1 minute. Okay, guys. So your underlying position is long, yeah? That will be in the notes. I'll put it in the notes. Okay, guys. Now, so your underlying. Now, what should you do now? We are going to make a distinction here between underlying hedge transaction and hedge position. Okay, here this component of your notes talks about the difference between hedge transaction and hedge position. Okay, so if your underlying position in gold is long, okay, now you're worried that your market analysis suggests that the outlook is bearish. Okay, so is your underlying position now is likely to make money or lose money? Lose money. So therefore you need to do something about it. You can't touch the underlying position. So what kind of hedge position are you going to set up? Short position. Okay, remember, a hedge position is a type of position. A hedge position is a species of position, right? Just like contract is a species of agreement.
Yes, sir.
Okay, so a hedge position is a species of position. So therefore there can only be two types of hedge positions, long or short.
Yes, sir.
Okay, so the question is, if your underlying position is long and you're worried that the market view is bearish, okay, then you have to set up a short hedge position. Okay, to set up a short hedge position, the hedged transaction that you will do. So we want to make a distinction between, we have to be very particular about the use of words. So the hedge transaction can either be sale or purchase of some asset. So just like position can be long or short, the transaction can be sale or purchase. Alright, so if I ask you what is the hedge transaction, don't say long. The hedge transaction should be buy or sale or purchase or sale. Okay, hedge position is long or short. Hedge transaction is sale or purchase. Are you following? So the use of words has to be you have to be very, very particular about the way you use words. Okay, so very simple point, but it's important to be clear about the distinction. So in this case, what you're going to do is you're going to sell gold. Yes? You are, because if you sell gold, if your transaction is sale of gold, then the resulting position is going to be a short position. Yes, if you do a sale of gold, then your resulting hedge position will be a short position, which will offset the losses on your underlying position. Yeah, what were you saying, Tanya? Use the mic if you can. Yeah, I gave the mic. Yeah, use the mic. Quiet. When she's asking the question, everyone else should be quiet. Okay, let's focus properly on the class.
So if we are selling gold, then the underlying position will change.
No, because you are not. No, 1 minute. Remember that rule. You can't touch the underlying position. The only way that the underlying positions change is when there are some changes in the business. The sales team makes a sale. So the sales team informs you that we have sold, say, 500 ounces of gold. If the sales team tells you, 1 minute, be quiet. Let's understand the question and let's understand the answer. Okay. The only way that the underlying position changes is when there are some changes in the underlying on the conduct of the business. I mean, as a result of the normal conduct of the business. So you started out with 2,500 ounces of gold. Now after say let's say 2 weeks, the sales team informs you that we have sold 500 ounces. So you're going to update your underlying position to now it's going to be 2,000 ounces, assuming there's no new addition to inventory. Okay. So if there's some new addition to inventory, some new gold has come out of the ground. Okay, that has to be added. So net change in inventory has to be always updated. So these figures should always be up to date. And you have to be, as a hedging team, you have to be constantly in touch with the sales team and other parts of the business. All right. So everyone who can give you relevant information in terms of updates and things like that. So you have to be in touch. That's the only way the underlying position changes. But you cannot do, as a hedging team, you can't do anything to change the underlying position. All you can do is watch the market. In this case, you're watching the gold market. Okay, as one of your KRFs is gold. You're watching the gold market. You're forming a view. In this case, you form a view that the market is bearish. Okay, so therefore you know, then from that view, based on that view, you can project that the underlying position is going to make losses. So now you know you have to set up an offsetting hedge position. And what kind of hedge position does it have to be? It has to be one which will make money when the market goes down. Are you following? It has to make money when the market goes down, because the underlying position will be losing money when the market goes down. So it has to be the opposite. So you need to set up an offsetting hedge position. Therefore, you need to set up a short hedge position. Are you following? And to set up a short hedge position, the hedge transaction that you will do is sale of gold. Yes? Okay? Are you following? Everyone is following this logic? Okay, so therefore you will go here, and in this case you're using gold futures. Now depends on which one you want to sell. Let's say we are going to take the nearer, this is too close, so we are going to sell the Feb contract. So you're going to click here and sell the Feb contract. Are you following?
Yes.
Yes? Okay, so I'm just going to cancel this because we don't want to do any transactions here. Keep the account clean. Okay, so this logic is clear now. So the idea here is you can read up your notes later on, and everything is explained in the notes pretty much. Either it's in the notes or in the project brief. Okay, either everything is explained in the project brief. What is the hedging logic? What you have to follow? Okay, we will have so this now. Anybody here doesn't understand the hedging logic now? What you have to do? Size up the risk book, identify KRFs, list down the underlying position for each KRF, then take each KRF by turn. Repeat for all KRFs. Take each KRF by turn, form a view on the market. If the underlying position is long and the market view is bearish, then you are going to lose money on the underlying position. You need to set up an offsetting hedge position. Therefore, you need to do a hedge transaction. And the hedge book, you have to think of it as hedge book is sitting on top of the underlying book. You do not touch the underlying book. You just set up offsetting positions when you are afraid that the underlying position is going to lose money.
Yes, sir.
So the hedge position, so the total P&L, remember when we defined speculators and hedgers, we talked about total P&L, a total position, okay, a total risk. We talked about total risk, okay. What first position will reduce total risk, and first transaction will reduce or increase total risk, okay. Now what is this total risk? Now you understand better. The total risk is going to be the risk of the hedge positions plus the the two positions are going to be the hedge position plus the underlying position. So when you are looking at your total PNL also, you are going to compute the total PNL, hedge PNL plus underlying position PNL. This is clear, right? So that's why you're hedging. If you get it right, if your view is correct and you get it right, then your underlying position, your net loss there won't be any net loss from this level. Say if I sell the entire 2,500 ounces of gold, there is no further, that means I've locked in the value of that gold inventory at 1465. Okay, because I sell the entire 2,500 ounces at this price. Now the underlying position lose money. Even if the market goes to 1200, the underlying position will lose money, 2,500 into 1466 minus 1200, but there will be an equal amount of gain on the futures positions, which is the hedge position. So the hedge position PNL will offset the underlying position loss, okay, the PNL. So is this clear? So the total PNL is what we are interested in. So a total PNL is basically locked in for the gold price at this level. Is everyone clear? You've understood the scheme?
Yes,
okay,
sir.
please go and understand. We still have some time.
Okay, sir.
1 minute.
Sir, 2 minutes.
So I have a question.
Yeah, what? Yeah.
So when we
Give her the mic.
so when we look at the
Mic is not working. Yeah.
so when we look at the hedge position,
Be quiet. Everybody else be quiet. You don't want to lose marks in the last over. Yes.
when we look at the hedge transaction of the hedge position, how will we define this particular transaction that we just did?
No. For the example of gold, the example of gold that we discussed. The hedge transaction is a sale. You can see it is written in your notes. Okay, go and study the notes that I've given you. Okay, it's all there in your in the technical note. Okay, now and the rest of the other ideas are in the project brief. So between the two, you'll get all the ideas that we have discussed today, and there'll be some other stuff. So the hedge transaction is a sale. What did I do? I sold gold. I engaged in a sale of gold. I sold gold, okay? So I engaged in a sale of gold. So the hedge transaction, when you describe the transaction, it's a sale of gold, okay? So the transaction is not short gold. The transaction is sale of gold. The resulting position is a short gold position. Is this clear? It's just using the words carefully. Sale versus short. Short is the position, sale or purchase is the transaction. Okay, transaction leads to a position. Yes, clear? Okay, yeah. In this case, you are using gold futures, but you can also use spot gold. It depends. Now, in this case, I have forced you to use futures. Okay, but this is a choice you can make in the real world because spot gold is also very actively traded, pretty much round the clock, 24 into 5. Okay, so you can also trade in the spot gold market if you want, and you can also trade in gold futures. The difference is in spot gold. Remember, what is the difference going to be? We have 1 minute. Let's answer this in 1 minute. What is one of the things that will lead you to choose spot gold? Is a what kind of market?
Very liquid.
It's very liquid, yes, but what kind of institutional arrangement? Exchange traded or OTC? Spot gold is OTC, and gold futures exchange traded. Okay, so therefore, what is one of the considerations that might move you to trade in spot gold? Flexibility, which means you can customize the contract size. Remember, here you can't. This is 100 ounces. This contract is 100 ounces. Okay, that's why, because in this project I'm forcing you to use futures contracts. That's why you notice that your gold position is a round multiple. If you want, you can sell like 25 futures contracts and hedge your entire gold position. Okay, but in the OTC markets you don't have that. You can ask for a price for 347 ounces. That's why you might decide, and as Parul said, it's also a very liquid market. OTC gold is very liquid. Okay, now you can go. 13 seconds. Okay. So please make sure you read up all the material. Okay, and we are going to start trading in. Okay, we'll start trading. Yeah. This is a technical question. Give her the mic. Give her the mic. Yeah.
Actually, I don't have a, I have a, but I want to clarify something. That you said on the liability side, we will call it as long and not short.
No, no. You're saying, what you're saying is the opposite.
Like
1 minute.
KRF.
No, 1 minute, 1 minute. Let's take the first statement that you made. The liabilities are always to be taken as being short. You're short the liabilities because liabilities are things that you have to pay. Okay.
But you said that underlying position is just on a basis that are we making money out of it? Like underlying position on asset side, if the price goes up, we are making money. So we are long over here on asset side.
Okay, you have one more class. Okay, never mind. Okay, so no, underlying position. What is it you are saying? Underlying position is.
Okay, a sector then you ask the underlying position. So firstly you go to the assets and you ask what is the underlying position of particular assets, and we told you underlying position of every asset, which I was understood. But then you go to the
So what is your understanding? What is the underlying position for copper? Why?
Because when the price goes up, we are making money. So we have long position.
Okay. So that logic will be clear. That why is it long? Because if the price goes up, I make money. The price goes down, I lose money. And it is only the long position that behaves like this, not the short position. So therefore, my position is long. So the logic should be clear. Yeah.
Then we are on this Aussie US you told that it's
Not you told, you said.
You said that it is short position.
Yeah.
But
No.
Sorry, you said it's long position.
In the dollar yen, we are long.
Yeah.
Okay. Maybe you can go back and listen to those discussions. We have discussed it twice. Okay, I'll explain it one more time. Okay, we have already discussed it twice in class, but I'll explain one more time. So, understand that in the case of the yen loan, okay, the case of the yen loan, the KRF market is either yen dollar FX or dollar yen FX. Okay, so your assets are in dollars and the liabilities are in yen. So you have to pay back the yen liabilities with dollars. So
It's US yen.
either you call it yen dollar or you call it dollar yen in the beginning at the starting point. Okay, you can call it either, but the KRF market is when you identify the KRF market for this balance sheet item, you would say that this is either the yen dollar exchange rate or the dollar yen exchange rate. It's pretty much the same, okay, because it's either one by this or it's this item itself. Okay, so it's either one by this or is this price itself, either one by 108.54 or okay. So now what we are saying further, when you're trying to go through this, because remember the process is that you have to identify your KRF markets, you have to be aware of what is the underlying position. Okay, now that's the part we are doing now. Why is the underlying position? We say with respect to the dollar yen market. Now here we are making a choice. We could have either looked at yen dollar or we could have looked at dollar yen. Okay, so I'm saying that you look at dollar yen first. It will create more complications, which is better for you because you'll learn more. Okay, and here let's look at it this way. Are you following this point? So we could have either looked at the KRF market, we could either looked at the KRF market with the dollar as the base currency, with dollar yen, or yen dollar with yen as the base currency. Okay, although we will be hedging using an instrument which is basically the yen futures. When we go into the hedge transactions, we will be trading yen futures, which is yen as base currency. Although we'll be doing that, but for the purposes of analysis and coming out with our decision on whether to sell or to buy, okay, that we will be using dollar yen because that is the more dominant market, the spot dollar yen market. Are you following? Okay, so there is a slightly more complicated situation. For analytical purposes, for understanding what the underlying position is, we will be using dollar yen. And when we have to hedge, we will be using yen futures, which is actually yen as base currency. Okay, so it will become more complicated, but that is where you learn more. Okay, so now we look at the dollar yen market. We have to apply the same logic.
are we making
We are
money?
now, the question that we have is the KRF market that we have identified is dollar yen. Okay, so it is dollar as base currency. Now we are asking this question: what is the underlying position in this KRF market? Okay, so the way to answer that is absolutely mechanical. We will ask ourselves, if this market goes down, do we lose money or make money? If this market goes up, do we lose money or make money? So now see what happens when the market goes down. You can think of it intuitively also. We can do it mechanically on the sheet. Okay, we can do it mechanically on the sheet, but it's better to think about it intuitively. Remember, in this example, the dollar yen is the base asset. I mean, the dollar is the base asset in this chart.
So this is my question. This price shows US dollar price or yen price?
No, it shows both prices, but the base asset is dollars.
So when it goes down,
So what is happening? Dollars getting weaker or stronger?
when it goes down, dollar is getting weaker.
Yeah, right. So when it goes down, dollars getting weaker. So yen is getting stronger. When this chart goes up, dollar is getting stronger, yen is getting weaker. Okay. Now, what is dollar, asset or liability for you? For you, in this case, in this KRF market, dollar is a asset or liability? In this case, in this example.
Liability.
Here, when you're looking at this loan for this KRF market, the dollar is like an asset or liability?
Dollar is an asset.
Asset, because your revenues, yeah, yen is liability, dollar is asset because your revenues are in dollars. How will you pay the yen loan? You pay with dollars. Okay, you use dollars to buy yen in the market. Okay, so if when the dollar weakens, if the asset is getting weaker and the liability is getting stronger, okay, now go back to this. Now you've identified that the dollar is the asset, and for this KRF market, the way we have defined it, okay, for this particular exposure on the balance sheet, the dollar is the asset and the yen is the liability. Okay, now we are focusing on the KRF market defined with dollar as the base asset. Okay, so and we look at the chart, you know that when the chart drops, dollar is getting weaker, yen is getting stronger. When the chart goes up, the dollar is getting stronger, yen is getting weaker. Now take the downside example. When the chart drops, the asset is getting weaker, liability is getting stronger. So is that good or bad?
Liability is increasing. It's bad.
It's bad, right? Because your assets are reducing, your liabilities are increasing.
Yes.
That is one way of intuitively thinking about it, right? Because your assets is increasing. So each, if you think of it now, when the chart, another way to look at it is when the chart is dropping, that means each dollar is buying less and less yen. Is it true?
Each dollar, yes.
Each dollar, when the chart drops, suppose it drops from 108 to 100, that means each dollar is buying less and less yen.
Yes.
Yes? So dollar is your asset.
Yes.
So each unit of asset is buying less and less of the liability. That means you have to put up total more dollars. That is a loss.
Yes.
Is that clear? You agree that's a loss?
Yes.
It's logical that it's a loss.
Yes.
Yeah. So this is how you should think about it. So now when you think about it, if you go through this process, okay, when the dollar is going down, each unit of your asset is buying less and less of the liability. Okay, so you have to put up more units of assets.
We are making money.
You're losing money. When each unit of the asset is buying less and less of the liability, you have to put up more assets to satisfy the same liability.
But the liability will remain same.
Liability remains the same, but your total assets you have to.
Making losses.
You're losing money, right? Each unit of the assets. Dollar is the asset. Each unit of the dollar is buying less and less of the yen of the liability when the dollar yen drops.
Yes.
Okay, so you are losing money because you have to pay up more and more of the assets. More units of asset have to be put up to satisfy the same liability. Yes.
Yes.
So that means you are concluding that you are looking at this KRF market. When the market drops, you are losing money.
Yes.
When the market goes up, obviously on opposite you will make money now.
Yes, sir.
Because now when the market rises, the market rises to 125. If dollar yen goes from 108 to 125, that means each unit of your asset is buying more and more of the liability. Are you following?
Yes.
Is it true?
Yes, sir.
When it goes up, that means each dollar is buying more and more yen.
Yes.
More and more yen. So each unit of asset, each unit of asset is buying more and more of the liabilities. So that means whatever you had provisioned earlier, you have to use fewer units of assets to satisfy the same liability.
Yes, sir.
So that is good for you. That means you're making money.
Yes, sir.
So you have a situation now in this KRF market where your underlying position is such that when the market drops, you lose money. When the market goes up, you make money. So what kind of position is this? Has to be a long position. Are you clear now? So you have to understand it logically. Don't memorize. If you don't memorize, then you will not be able to answer. If I change the question, if I change it to like Norway or Mexico or something, then you will not be able to answer. You have to understand the logic, right?
Yes, sir.
Yes? Yeah, you also have a question. Okay.
Sir, if
You have a
the hedging
question?
help us to in reducing our losses,
What?
hedge transaction help
Yeah.
us to reduce our losses, then it will also reduce our profit. If our underlying view
Yeah,
is
so the goal is not to make profits. The goal is to minimize loss. You'll see this written in your notes. When we discuss hedging, the goal of hedging is to reduce. Yeah, welcome. So, remember the very beginning of hedge transaction and hedge position. It's all there in your notes. So the goal of hedging is, you have to understand, the goal of hedging is to basically bring certainty to your cash flows. So we showed you this example in the case of gold, where if we lock in the gold price at that level, okay, and if our view is correct that the gold price is bearish, that the outlook is bearish, so once I sell the entire 2,500 ounces of my underlying position, equivalent of that I sell in through the futures contracts in my hedge portfolio. Okay, so my hedge position goes to minus 2,500 contracts at 2,500 ounces. Okay, and the underlying position is plus 2,500 ounces. So my net position is zero. So whatever from this point onwards, I have actually locked in a 1466 price for my entire gold inventory. Because even if the market price drops to 1100, the underlying will lose money between this to this, but the hedge position will make a corresponding amount of money. So the total PNL, hedge PNL plus underlying PNL will end up being no difference compared to what the price was, compared to what it was when the market price was 1466. Are you following?
yes, sir.
So the goal is basically, we have satisfied the goal of hedging. The goal of hedging is not to make money. The goal of hedging is to bring certainty to cash flows. Now we have done that because we have made our cash flows certain. No matter what happens to the gold price, we will realize a net price of 1466 on our gold inventories. Absolutely locked in. No change is possible. So we have brought certainty to our cash flows. This is the goal of hedging. Okay, unfortunately many even professional hedging teams, they don't understand this concept clearly, so they start speculating. They start to forget where the hedging stops and where the speculating starts.
So
they forget all that.
The only reason for hedging is to minimize your losses and sustain your cash flow.
Yeah, to bring certainty to your cash flows. What was the problem in the EuroDollar floating rate loan? We don't have certainty on cash flows because these we don't know these rates. We don't know what the fixings are going to be. Fixing in March, fixing in June, fixing in September. We don't know what it is. If I now actually sell, in this case, if I sell the EuroDollar futures contracts at these prices, I have effectively locked in these. I have locked in these prices. That means essentially I have ensured that my net fixing cost for net interest rate cost for 3 months to 6 months is going to be this, for 6 months to 9 months is going to be this, and for 9 months to 12 months is going to be this. I've locked in. I have no more fear. The interest rates can shoot up to 15% also, makes no difference to me.
Okay, so from uncertain interest rates,
I have now got certainty for my cash flows, which is a huge advantage in a corporate setting, because I can now focus on my business. Remember,
you can also forecast on this futures.
No, you don't have to do any for this point, for these exposures. Now my job is done.
Okay.
Because I've locked in these rates. Of course, we can talk about a dynamic hedging program, which is slightly more complicated. We don't need to worry about that at this point. But if you look at a passive hedging program, okay, which is a static hedging program, where this is the most conservative approach to hedging. Okay, so we have done our job. We have locked. If these rates are acceptable to the company, If the company is okay with paying 172, okay, for the next fix, 164 and then 158 and a half, if the company is okay with that, then you have done your job. Now you can forget about this. So this is the objective of hedging, is to bring certainty to cash flow. So the business, remember what we said, that that these companies are not in the business of speculating on these kinds of markets. They are in the business of running the business and running a mining operation, extracting efficiencies for the value chain. So the goal of the hedging team is to bring certainty to cash flows wherever there is uncertainty, because wherever there are underlying positions and actively traded KRF markets, there is a lot of fluctuation in prices possible, and that may go against you or may go for you. So there's uncertainty to the cash flows. So there you lock in certainty for your cash flows. That means you cannot lose money anymore. Okay, so it's a very defensive approach. The classical approach to hedging should be a very defensive approach. The idea is to remove the risk, and so that the business can concentrate on the conduct of the business, or running an efficient mining operation, or running an efficient sales operation. Okay, that is what the business is meant to focus on. The business is not meant to focus on fluctuations of market prices. This is clear.
And sir, if our underlying position is long,
Yeah.
and the hedge team thinks that the market is going to fall,
Yeah.
then they sell the whatever they are. Let's say
Wherever they are hedging.
Yeah.
Where, like in this case, we are hedging through futures contracts.
Yes.
So if your view is that the underlying position in gold is long, and your view on the gold price is bearish, then you would sell the gold futures.
Yeah. But,
or you
at
could
the-
sell spot gold if you were
but
doing
there
that.
is some news in the market, like there was an attack on oil facility.
Yeah.
Something like that. Then in the next morning, the price rise up, shoots up.
Yeah.
When we earn our profit on the underlying position,
Yes, the hedge
but
position
then
will
the
lose
hedge
money.
will lose money.
Lose money, but
Then
you're
it
still
is
locked
zero.
in. You're still locked in at whatever price you go short. You are basically locked in that price. So in this case, if we go short at 1471, we have locked in 1471.30.
So then in that case, we won't be able to realize more profit from that news. Or from that movement.
So that is, if what you're talking about is you're pushing towards you're pushing towards an active or a dynamic hedge program. Okay, dynamic hedging program, which is a second level consideration. We are not going. First, let's understand the simple case. Okay, so in the simple case of the static or the passive hedging program, we are not going to do all that, because as far as we are concerned, even if gold prices rise to $1,900, we have locked in 1471. That's why I said whether this is acceptable to the business. Okay. Is it acceptable to the business to sell its gold inventory at 1471 at an effective price of 1471? After you have hedged, then the market might even shoot up to 1900. But if you are okay with 1471, if it gives you a good margin, okay, you're able to lock in a good operating margin with 1471, then you should do it. Because if you wait out for the move to 1900, well, it could even go down.
Down to 900.
So the goal of hedging is not to make money.
Just
The goal of hedging is to lock in a reasonable profit margin for the business and bring certainty to cash flows. Now you have brought certainty to cash flows because you have crystallized the cash flows. Right? Yes? Clear?
Yes.
Okay, good.